1.18 USD. That is the number flashing on your screen right now if you are looking at iRobot Corporation, ticker symbol IRBT. If you are watching the intraday movement, you might be seeing a chaotic scramble, high volatility, massive volume spikes, and a ticker that looks less like a stock chart and more like a heart rate monitor on its final beat. The market is currently processing what is arguably the most devastating news a shareholder can receive, and the price action reflects that confusion, panic, and ironically, the dangerous optimism of retail traders who haven't read the fine print. You might see it bounce to $1.20 or dip to $1.10 in the next few minutes, but let's be absolutely clear about what we are witnessing. This isn't a dip. This isn't a correction. This is the end of the line for the public equity. Expectations in the stock market are a powerful drug. For months, arguably years, the expectation for iRobot was that of a fallen angel, a tech pioneer from MIT that created an entire industry currently down on its luck, but surely valuable enough to be saved. The narrative was simple. They have the brand, they have the patents, Amazon wanted them for $1.7 billion, so surely they're worth more than a few dollars. That was the expectation. The reality, which hit the wires just recently, is a cold, hard Chapter 11 bankruptcy filing with a restructuring agreement that explicitly states common shareholders are expected to receive nothing, zero. The disconnect between that expectation of a turnaround and the reality of a total wipeout is where fortunes are being lost right this second. If you were sitting there with your trading app open, maybe you use Robinhood, or perhaps you were looking at your Fidelity mobile app or Interactive Brokers platform, you might be tempted. You see a stock that traded at nearly $200 during the pandemic, now trading for the price of a pack of gum. The psychological pull to buy the low is immense. You might be thinking, if it just goes back to $5, I quadruple my money. But we need to have a serious, smart friend conversation about what cancellation of equity means, because the financial jargon in these filings is designed to be precise, not friendly. When a company files for Chapter 11 with a pre-packaged deal like this, specifically handing the keys over to a lender, in this case their manufacturer, Picea, the stock you hold in your Schwab Intelligent Portfolios or your SoFi Invest account essentially becomes a souvenir. Let's look at the immediate market mechanics playing out today. The volume is skyrocketing. Why? Because algorithms and high-frequency traders are feasting on the volatility, while institutions are likely liquidating whatever positions they have left to write off the tax loss. You might see comparisons to other meme stock situations, but this is fundamentally different. When you look at Tesla stock or Nvidia stock, you are looking at companies with growth narratives. Even when they dip, the equity has value. Here, the equity is being vaporized to satisfy debt. The intraday swings you are seeing on your Fidelity trading platform or Interactive Brokers stock trading screen are the death throes of the equity, not signs of life. It is crucial to understand how we got here to understand why the market is reacting this way. This wasn't a sudden accident, it was a slow-motion car crash that everyone saw coming but hoped would swerve at the last second. The first domino fell when the Amazon deal collapsed. Remember that? Amazon was going to buy iRobot for $1.7 billion. It was the golden parachute. But European regulators blocked it, citing antitrust concerns. When that deal died, iRobot was left with a bloated cost structure, falling sales, and no plan B. They had bet the farm on that acquisition. Once it fell through, they were left drifting in the ocean without a life vest. Then came the competitive crushing. While iRobot was busy with lawyers trying to sell itself to Amazon, competitors like Roborock, Echovax, and Shark Ninja were eating their lunch. They innovated faster, launching vacuums that could wash mops, empty themselves, and map homes more efficiently, often at a lower price point. The moat that iRobot had, that brand recognition of Roomba, evaporated. If you look at the charts on your Robinhood app or SoFi investing dashboard, you will see that sales have been declining for quarters. It wasn't just that people weren't buying vacuums, they were buying other people's vacuums. And then the final nail in the coffin, the balance sheet. In their recent Q3 2025 report, the numbers were terrifying. Cash and cash equivalents had plummeted to just under $25 million. For a hardware company with global logistics, that isn't even operating money. That is keep the lights on for a week. They had negative equity, meaning their liabilities exceeded their assets. They were drowning in debt, much of it owed to Picea, their manufacturing partner in China. This is where the story gets really interesting and where the reality completely overtakes the expectation. Usually, in a bankruptcy, you expect a fight between creditors. Here, the creditor is also the manufacturer. Picea, the company that actually builds the Roombas, essentially said, "You owe us too much money, so we're just going to take the company." It's a credit bid in spirit. They're forgiving the debt in exchange for 100% ownership. This transforms iRobot from a public Nasdaq-listed company into a private subsidiary of a Chinese manufacturing firm. For the company iRobot, which is what you and I are talking about, it's the end. If you were looking at this on a Fidelity brokerage account or managing your own funds via self-investing on a platform like E-Trade or Ally, you have to separate the product from the stock. The Roomba in your living room will keep working, the app on your phone will keep updating, but the shares in your portfolio are on a one-way track to cancellation. This is a classic trap for new investors who use investing sites or online investment help that doesn't emphasize the mechanics of bankruptcy. They see iRobot bought by manufacturer and think buyout equals premium. No, this is acquisition in bankruptcy. The purchase price is effectively the debt forgiveness, and the equity holders are at the bottom of the waterfall, getting nothing. Let's pause for a second. I want to know where you stand in this chaos. Comment below how many shares of iRobot you currently hold, or if you managed to get out before the drop to $1. Do you think the regulators were wrong to block the Amazon deal, or was iRobot destined to fail anyway? The regulatory aspect is a huge part of this debate. If the EU hadn't blocked Amazon, shareholders would have been cashed out at a significantly higher price. It's a bitter pill to swallow for anyone who held on thinking the government was protecting consumers, only to see the company collapse into the arms of an overseas manufacturer instead. Now let's look deeper into the trading psychology of today. Why is the ticker trading at $1.18 and not $0 right now? There are a few reasons, and understanding them can save you a lot of money in your online investing journey. First, there is always a short squeeze theory. Short interest in iRobot has been high. When a company declares bankruptcy, short sellers eventually have to cover to close their positions and realize their profits. This buying pressure can create temporary spikes known as dead cat bounces. Traders on Robinhood Investments or those using high-speed tools on interactive brokers' trading platforms often try to ride these waves. It's dangerous. It's like picking up pennies in front of a steamroller. Second, there is sheer speculation. Some traders believe that maybe, just maybe, a white knight bidder will emerge to top Picea's offer. They think, hey, maybe Shark Ninja wants them, maybe Samsung. But in a Chapter 11 process, the stalking horse bidder, Picea, has a massive advantage because they are paying with debt they are already owed. Any other buyer would have to pay actual cash to pay off Picea and offer something to shareholders. Given the financial state of iRobot, bleeding cash, declining sales, massive tariffs looming, the likelihood of a bidding war that trickles down money to common shareholders is microscopically small. It's also worth mentioning the macro environment. We're in a market where efficiency and moats are everything. Look at Apple stock. Apple has a walled garden. Once you're in, you stay. Look at Tesla stock. They have the charging network and the data. iRobot had a patent portfolio, but patents expire, and aggressive competitors found ways around them. The hardware is hard adage is true. If you are using Schwab Intelligent Portfolios or looking for investment help, you'll often hear advisors say to look for companies with reoccurring revenue. iRobot tried to pivot to software and subscriptions, but at its core, it was still selling plastic pucks that clean floors. When the economy tightened and inflation hit, people stopped buying $800 vacuums and started buying $300 alternatives that worked just as well. This brings us to the future outlook section of our analysis, although for the ticker IRBT, the future is short. The stock will likely be delisted from the Nasdaq soon. Typically, when a company files for Chapter 11, they receive a delisting notice fairly quickly. The stock then moves to the OTC markets, often with a Q added to the ticker, IRBTQ. At that point, many mainstream brokerages like Fidelity Investments or SoFi Invest accounts might restrict opening new positions. You might only be allowed to sell. Liquidity dries up. The bid-ask spread widens. If you are holding the stock hoping for a miracle, you're betting against the explicit language of the restructuring support agreement. The company has stated clearly, holders of